Good afternoon. Thanks for joining our 2024 Market Outlook webinar. Last year was a surprisingly really good year for stocks. The S&P 500 performed much better than most analysts predicted. But last year was also a very narrow-based year for stocks. There were actually 7 companies that were responsible for over 70% of the growth in the market. So just companies like Facebook, Apple, Google, Nvidia, Amazon. So those companies were responsible for most of the growth. In fact, if we met on November 1st of last year, the Dow was actually negative at that point last year. So what are we expecting for this year? To help answer that question, we invited one of our partners, Danny Cohen of John Hancock, to provide their outlook. Danny and I have worked together for many years now. Some of you probably heard Danny speak at some of our other events, whether it's been Social Security, Medicare. Danny was also our guest speaker last year at our Market Outlook, and to pump Danny's ego up, at the time he was quite bullish, which was very, very unpopular at the time, but it ended up being spot on. So, Danny, we're excited to have you. Danny's also going to cover the bond markets, some areas of opportunity and some areas we should potentially be concerned with. So, Danny, please take it away.
Thank you, John. Good afternoon to everybody, and thank you again for having me. Appreciate the time, and a happy Valentine's Day to everybody. For those of you who've been married a long time, which I've been for 27 years, I think this presentation might be a breeze versus trying to fill out a Valentine's Day card after 27 years and figuring out what you're not going to say that's repetitive the last 5 years. So that'll be fun, right? I got a smile from Omaid, he knows. So happy Valentine's Day. Thank you so much for having me. And John, thank you for the kind words as well. So we'll talk about the markets, and I'll try to provide some color and give you a sense of what went on yesterday and what's looking good and what we're thinking into 2024. Let me switch the slide presentation here and go right to the presentation from the beginning here. This should load up. John, you should see this, so maybe just give me a nod.
Yes.
Just so I know you can see this. Okay, great. All right, so let's get underway. I guess we'll intermittently stop here after some slides. I'll maybe take a question or some comments maybe from John and let him come in so we can have some banter. All right, so let's talk about the market intelligence. For those of you who I have not met, I am a senior business consultant with John Hancock, and I spend a lot of time talking about Medicare and Social Security. Some of you may have heard me do the Social Security presentation, but more often than not, we are talking about the markets with advisors and their clients. So the Market Intelligence book comes out once a quarter. It's in color here, as you can see. And what this is really is a combination of opinions of all of the asset managers we work with, firms like T. Rowe Price, obviously John Hancock, JP Morgan, a number of different firms in the industry, but it also includes what we refer to in the industry as broker-dealers, firms like LPL, Morgan Stanley, Merrill Lynch. All the opinions are gathered here at John Hancock. There's about 85 firms that give us opinions once a quarter. They're gathered and disseminated out to financial advisors. And of course, it's client approved. And you see here, it's a nice presentation. So I know a number of you are anxious to wonder what some of the opinions are. So there's 3 sections in this book. There's a section on US equity, international equity, and fixed income. So I'll cover a few slides in each. That way I won't put you to sleep and we can get some thoughts on different parts of the market. So let's start with the US equity section. I know that's everybody's favorite from the standpoint of performance of late. So let's talk about that. So how you read this when you look at it is the darkest navy box that you see on the right is the consensus opinion of what this network of 85 plus firms that we listen to thinks. Now you will see some outliers here in the light blue. There are some of the firms that we listen to that do have opinions of neutral to slightly bullish. You'll see there's a slightly bearish opinion here in dark navy from the majority of the group, but John Hancock's specific opinion is the orange diamond. So the orange diamond is specifically one opinion, and it's only the opinion of John Hancock. So as a mutual fund company, investment firm, we like to be positive, and of course, equities have done very well over the years, which is partly the reason why we are bullish in the equity markets. But as you look at this more closely, you might be wondering, okay, I see they're bearish. Why are they thinking that way? And, I notice at the bottom in US growth, they're bearish, but they're bullish in US value. So when you think of growth stocks, you think of things like Apple or Microsoft, things that are growth companies, and you might be wondering why would they have an opinion of bearish. And when you think of value companies, these are things like financials or industrials. The energy stocks typically fall into the US value sector, as well as a lot of stocks that pay dividends, things like real estate investments, REITs was what we call them. And of course, utilities fall into the US value category. And healthcare, in essence, kind of falls into both. It's a growth stock, but you typically see healthcare in the value fund. So healthcare has done very well year to date. It didn't have a good year last year. But why do we have this opinion of bearish? The reason is a number of firms, including ours, refers to this Conference Board leading economic indicator slide. And what it's showing you here on the right is 10 indicators that tell you whether things are going well or things are not going as well. So if you look at the one most recent that we received here in November, it was showing you at that time, 6 of the 10 were negative, 2 of them were flat. And of course, the most important one, stock prices were up, right? So it's one of those things where you may tell me that weekly manufacturing hours have slowed, or the ISM index new orders has slowed. But if you tell me my stocks and my portfolio is positive, that's the most important thing at the end of the day, because everybody cares, for the most part, what's in their bank, right? Or what's in their investment account. So that's the most important one of the 10. I think we would all agree, but you can get a sense of why this bearish opinion is still out there. You hear it on CNBC from time to time, or you hear it on Bloomberg television. But the truth is the economy has been very strong. As you know, the employment numbers have been very strong. They came out a couple of weeks ago, and that was a big number. And of course, yesterday, you heard that the CPI number, the Consumer Price Index number, was very high. Now, I'll say to you, in that realm, the market sold off over 700 points, but I wouldn't necessarily be over concerned. Number one, that's a little over 1% in the decline. But more importantly, a lot of that had to do with shelter. So inside of that CPI number, housing is a big part of that. And of course, rental income has gone up. I think most of you who are friendly with a realtor at this point, you're probably feeling maybe they should be working at an ice cream shop, as you might make more money selling ice cream these days than representing a house. It's a tough market, as you all know. Not a lot of houses for sale. So there's not a lot of inventory. And with interest rates at 7%, it's highly unlikely everybody's running out to sell out of, the house they're in when they're maybe paying 3 and change. So that's pushing rents up. And that's a big number. You have to realize, obviously, if we're going to keep the mortgage rate at a high number on a 30-year fixed at 7, call it, or 6.5, whatever number you're getting, you're going to push the rates up on rents just because there's not really a lot of housing available. So that's an important aspect of understanding what you're seeing right now and why you saw what you saw yesterday. The market didn't like it. It sold off. But the good news is today's a lot better. You've had people buy stocks and you've seen a little bit of a sell-off. So let me stop there just for a quick second, John, see if you want to interject anything while I'm talking.
Danny, where do you see inflation going right now? What's John Hancock's view?
Yeah, so most people will tell you, that it is obviously coming down, and they feel that, that's going to be very good for bonds, and we'll cover that as we go. I think a lot of you've seen the number around 3%. If you looked at it a year ago, we were a lot higher, than 3.1, 3.4 timeframe. Now they want to get us to 2, at least the Fed does, but it's highly unlikely we're going to hit that number earlier in the year. But as we get to the middle of the year, even if we're not at 2, it's highly likely that the Fed will lower rates because they see inflation subsiding. And I think you would see that obviously in gas prices. They've come down. The one that I think that bothers all of us, including me personally, John, is just the cost of food, right? And that plays into this, the CPI core number, or CPI, excuse me. And that's important just because, when we all go to the grocery store, it's hard to leave without having a $300 to $500 bill, depending on how many people are in your family. So I'm sure you looked in the bag, John. You probably had a bunch of Doritos and Ruffles in there with some fruit, and you left, and you're like, how was it $350? But that's kind of where we're at. I'm getting a little away from your question, but the point is, you are seeing inflation come down. It's more so in the food where it has remained sticky. And obviously, the job numbers are high, which causes some concern as far as the Fed deciding whether to lower rates because inflation is a little more sticky.
Okay, sounds good. Thanks, Danny.
Yeah, sure. Okay, so as we move into the second slide here, if you're just wondering about the S&P 500, and more often not, on our side of the coin here in the business, we typically refer to the S&P 500 as far as what's going on in that index. And the reason is it's obviously a broader index than the Dow being 30 stocks, and then the S&P obviously being 500. You get a broader based view. So just so you understand the breakdown in the middle, IT technology is obviously the biggest source of return inside of the S&P. You see it here at 27%, and then healthcare is the next one here at 13 and change. But you may be wondering about real estate, energy, materials, and utilities, and you'll see there is not really a big impact from these stocks, and that's why you see the S&P a little bit more volatile from day to day because it is so technology heavy. Though technology, a couple of stocks yesterday didn't do too bad, so that kind of held up the index a little bit more. But this slide will just show you where we are as far as our favorite sectors. Obviously, on the right here, IT. I think you all know the Mag 7, the big tech companies like, you look at a Microsoft or you look at a Salesforce, these stocks have done well. You look at things like Microsoft, obviously done very well. So, these stocks are something where in information technology, you're typically going to own these in your portfolios in some way, shape, or form because they're typically in every mutual fund or some type of investment that you have in an ETF or whatever it is. Healthcare, very good area this year. Obviously, that's a core part of people's portfolios. And utilities don't typically do well when rates rise. And that's a big reason why you saw last year utilities underwater. They lost about 12%. But everybody feels a lot more positive this year as we've seen rates subside. So that's an area that the firm likes. And obviously, it's an area of quality and it pays you out a dividend. So another area of safety for people. All right. So just a couple areas that we like in the group has somewhat of a neutral opinion here, but specifically at John Hancock, we like the mid-cap sector in general. And the reason is very simply, when you look at the index for large cap, which is the Russell 1000 index here on the left, you'll notice industrials in that index is at 9.5%, whereas in the mid-cap sector, industrials account for 19%. And when you look at the mid-cap index, the biggest sector in that category is industrials, or in that index, I should say. So this is really important as thinking forward and saying, okay, what are some things in our portfolio maybe we should be thinking about? So you might remember during the pandemic, in the height of it, 21, 22, we had a shortage of cars, and we had a big shortage of vehicles. It was tough. You went into a dealership and you needed to buy a car. There was only, a few cars on the lot, and it probably wasn't the one you want, and it was very expensive. What was the big reason for that? The big reason was the shortage of chips coming from Asia. So what you'll notice is a number of firms, especially in the auto, EV and semiconductor space, reopened plants here in the United States. To give you a sense of some of the auto companies, companies like Ford, Honda, Rivian, Hyundai, Toyota, all these firms reopened plants here in the United States for manufacturing here on our continent. And then you'll see in the semiconductor space, which is the orange here, you had companies like Intel, Micron Technology, Texas Instruments reopened plants here. So we created a fair amount of jobs. You can see it here. And the state of Ohio is where you got the biggest amount of jobs created. And that's why you see the concentration of blue in that area here in the Northeast. So this is important when you start thinking about the industrial sector. There's a lot of manufacturing, even though the companies I mentioned are large cap companies, they're giving jobs and creating business in the mid cap area. And that's a big reason why we like this sector in general.
How about small caps?
If you look at mid caps,
How about,
sorry, go ahead. I'm sorry.
what's your opinion on small caps?
Well, we're not as bullish in that area for a couple of reasons. Obviously, you see the Russell 2000 here has 17% in industrials, so that will help. December was very good for small caps once the Fed told you, they weren't going to raise rates. It was also good for mid caps, but we've rolled over a little here at the beginning of the year in small caps. And part of the reason is there's a little bit of concern in some of the regional banks having commercial loan space on their books. And I'm sure a lot of people have seen this on the news or just think about commercial office space as being a concern. Some of the banks have some of that on their books. And for those of you who saw the 60 Minutes interview with Jerome Powell a couple of weeks ago, you would have heard him talking about it. He said, we're not that worried about it, but we're watching it. And of course, Janet Yellen, the Treasury Secretary, had just talked about this in the last week. So it's something they're watching closely, John, and it's something I would say, at the moment, you're probably a little bit better off in the mid cap than the small, just because you're going to get a lot more volatility and you won't have as many regional banks or banks in the mid cap area as you do in the small cap.
Thank you.
Okay. Good question, though. All right. So just a quick comment on the mid caps here. You can see that the discount currently in mid caps here in the circle is very similar to the discount we saw in 1998. And then you saw mid caps here go on to outperform large caps at that point. And you'll see here on the right that mid caps are one standard deviation cheaper than what they normally trade out. So it's not to say that you should be running out tomorrow and buying, mid cap stocks, but it's just to give you a sense that everybody has large cap on the brain for the most part because it's done so well. It just gives you a thought on something else that you might be thinking about in portfolios. All right, let's move on from this. So let's talk a little bit about bear markets and recovery. I've shown this slide in the past. Maybe some of you have seen it, but I know this is one of John's favorites because you might wonder, why do financial advisors tell you to stay in the market and don't necessarily move away from your financial plan? The reason is that when the market goes south, you have to be right twice. You have to be right about selling at the right time. And then more importantly, the tougher one is knowing when to buy back in, right? Not so easy. So if you look here on the right and you slide down your eyes to October 12th, 07, that was the market peak at that time. And then you'll see peak to trough decline. What that means is the peak was 07. The trough, which is the bottom, they're not showing you the date, but that was basically March 9th of 09. So from October of 07 to March 9th of 09, you lost 56% in the S&P 500. And you might have made a call and said, hey, John, listen, I can't take it anymore. Can you get me out? And of course, that would have been a mistake because 1 year later, if you go out to March 9th of 2010, what does it look like 1 year later? You're up 66 and change. And then, of course, 3 years later, what's your return look like on average? 26%. So this is why we tell you time in the market and don't try to guess when the right time to get in or out is, because it's very difficult, as I said, to be right twice. John, I know you probably want to add something here. I think I did most of your talking there, but let me stop for a second and just see if you want to add something there.
Yeah, I think it's just always important to stay focused on the plan and not make knee-jerk reactions, no matter how tough it is. You want to stay invested and not make an emotional decision. So, I mean, I think the chart,
Correct.
2007 to 2009 is very telling. I remember March 9th of 2009 when the market finally bottomed. And if you stayed invested that whole time, 3 years later, you were up significantly.
Correct. Okay, let's move on from here. Let's talk a little international. So you'll see here, John Hancock has a bearish opinion in orange on a slightly bearish opinion in international equity. The group is neutral, as you can see from the darkest navy square. And you may be wondering, why is that the case? You'll see Japan, they're bullish on. And then you'll see the orange diamond, John Hancock slightly bearish. On Japan, I'll just say this. It's interesting last year that Warren Buffett was spending a lot of time in Japan. And Japan had a very good year last year. But, just to give you some thought, why do you have a bearish opinion from us? Why do you have a neutral opinion from the group? So those of you who follow manufacturing numbers, this is a purchasing managers index slide. They call it PMI data numbers. They come out once a month. Every country has one, including the United States. And what you notice here on the right, when the number is under 50, it is considered contractionary. You'll see in blue on the left, the arrow pointing down. When the number is over 50, it's considered expansionary. So some of the concern in Europe and Japan is the fact that the manufacturing numbers still show on PMIs under 50. But of course, in China, they've crossed over 50. To make you feel better, the other countries besides China are doing better in performance versus what China is doing right now. So sometimes maybe the more you know, the less you know. So just something to be thinking about. That's one of the reasons why you get, from a global perspective, some of this neutral opinion on international. But a lot of it really comes down to currency. And as the dollar strengthens, and you'll see that here from basically 1979 through to about 1986, when the dollar increases in value, meaning the US dollar, that's typically better for the S&P 500 performance-wise. And you can see here 106 versus the MSCI EFA, which was up about 50. And then when the dollar falls, you'll notice here from about 1986 through to about 1989, you'll see international does better than the US, and it's pretty much following that path. Now, if you look 2009, 2008 and beyond, you'll notice the US has had a really good run here where the dollar is been ruling thumb. And of course, as you raise interest rates, that strengthens our dollar, which is obviously good for the S&P 500. Now, when the dollar falls, like you saw it fall at the end of the year, you'll see here that it's not as good for it's not as good for the S&P, but it's good for international. So to give you some perspective on that, last year, the US dollar, which is DXY, for those of you who want to look that up ever, DXY is the US dollar, was down about 2% last year. And this year, out of the gate, it's up a little over 3%. So that's been very good for US equities already, not as good for international equities. John, I'll stop there just for a sec, see if you want to add something in.
No, I think that chart's very telling. I mean, people have been talking about international. There's been it's been undervalued for 15 years. So,
correct.
Yeah.
Right. Well, the truth is, people don't just buy things because they're cheap, right?
Yeah.
They need a catalyst for the performance. So a lot of times when the dollar falls, that's a big reason, or they think the dollar is going to fall. So if interest rates go down in the second half of the year, that could be a tailwind for international, but you're doing a little bit of guesswork there.
So Danny,
all right, let's talk fixed income.
On bonds and your forecast on interest rates. What do we see in the next?
Yep, let's go there. Yeah, so you'll see we're bullish in fixed income here, the orange diamond. The group is in the neutral to slightly bullish. And you'll see mortgage-backed securities, they're very bullish on, so are we, and then U.S. investment grade. This is the highest quality of the bond market that you're typically going to get outside of treasuries, which is U.S. government. So, with the decline that we've seen in the bonds the last few years and the perception that rates will come down in the second part of this year, given that inflation has subsided, hopefully at that point, that would be a good tailwind for bonds. So just to kind of give you an example here, this is a little bit of a mathy slide, but I'll do my best to explain it to you because it'll give you a sense of understanding pretty much what goes on in the bond market. So if you look on the far left in the blue chart here, or at least the column, what you're going to see here is the 10-year treasury note, what that yield was on the date of the last rate hike. So if you went to the bottom, you'll see July 26th of 23 was the last Fed hike, right? So you were at 3.85 on the 10-year treasury note. Now, it hasn't really played itself out, but if you went back to 2018, in December, you had a 2.78 10-year treasury note. What happened 6 months later? The 10-year treasury note yield dropped, and in the green column, we were sitting at 2%. So what is the decline? The decline in the third column shows you that you had a decline of 0.78, which is 78 basis points, a little less than 1%. That's very good for bonds in the sense of as the yield comes down, remember, it's an inverse relationship. So that means the price of your bonds go up. And these are good environments typically where you see the bond market do well. When you see this decline in yield, that's a very good thing for prices. So throughout history, after the last rate hike, typically 6 months later, you've seen yields fall. And when yields fall, you tend to see a price increase.
But
Now, we
Danny,
haven't necessarily seen that. Yeah, go ahead.
Danny, for your John Hancock bond fund, what's the average bond
Yeah.
price trading at right now in that fund? Which is an
Yeah,
investment.
it's 95 right now, so you have a discount,
Mhm.
which is really the reason that you're looking at a tailwind in bonds. So about a month ago, John, it was sitting at about 87.5, and now it's sitting at 95. So you have a lot of people out there now trying to get their hands on investment grade and mortgage-backed securities. And the reason for that is when Fed Chair Powell told you in December that he's not raising rates any longer, the bond market started to rally before he spoke, but you'll notice CD rates have peaked. Last year, you could get a CD at 5.5, let's say on a 1 year. Now you can get, let's say, 4.8 and below. So as that number comes down, people tend to chase bonds, especially when they're discounted. So by the Fed taking themselves out of the picture with raising rates, that is good for the bond market, and that's why you have the tailwind.
Thanks.
All right, quickly on the right side, you'll just see what it looks like 12 months later from what it looked like on the blue. So from blue to red, you see the yields are a lot lower. Hence, you see a bigger decline in interest rates or yield coupon. So thereby that is good for pricing of bonds, and your overall total return ends up to be a good one. So just to understand math, what's your risks in bonds and what's your tailwinds, just so you understand this. So for those of you who follow the 10-year Treasury note, and maybe you're going to be talking to John more so about this than maybe looking at it yourself, but just to give you some math, this morning, the 10-year Treasury note's at 4.31. 4.31. It spiked yesterday because of the CPI number. But the 10-year Treasury note at the beginning of the year basically was just under 4%. So let's just assume that you're at 4. Worst case scenario is interest rates go up 1% to 5 on the 10-year Treasury note. What would happen? Well, you would end up with a little bit of a negative return in that case, because you would lose some of this duration of 6, but your coupon would be added back, so the return would not be too bad. And that's worst case scenario. But the more probable case, especially with the Fed lowering rates and giving commentary about rates possibly going down in the second half of the year, if we go from 4 to 3, call it, and that could happen very fast, you're looking at a return here of about 10% plus. And I think that's where most people think we're going at some point. Maybe not 4 to 3, but they think we're probably going back under 4%. And that's why you have such a strong opinion from a number of these firms on an investment grade, high quality income. So let me stop there, John, because I've taken a fair amount of time here and just want to make sure we have time for questions or from some commentary from you.
No, I mean, so we don't think any recession this year.
Well, that depends on who you talk to, right? If you talk to a global economist, they'll tell you they think maybe there's a little bit of a slowdown and maybe the R word comes up. But most people will tell you no. And I think as much as I work for John Hancock, I can tell you one of the key indicators is if you look at lower quality bonds, anything that's a high yield bond or a bank loan, which pays you a higher yield and has a lot more risk associated with it, those bonds and loans have not sold off. So if you're worried about a recession, you typically would stay away from high yield bonds, and you would typically stay away from bank loans because they're lower grade paper. You're not seeing any selling from those categories, which, as much as they talk about potential recession down the road, the institutional people and the investors today do not believe that is to be the case, because if they did, they would be selling away from that stuff, and they're not.
So overall here, you guys are pretty optimistic, I guess, for equities for this year. And it sounds like you really like fixed income.
Yeah, so the first part I would say is we do like fixed income. I don't think we're that much different than a number of firms. And the reason is because once the Fed takes themselves out of it as far as raising rates, and they go on 60 Minutes telling you that everybody on the panel or on the committee is very much for lowering rates in the second half, that's a really good tailwind for bonds, especially when you have a discount. It's one thing if the bonds were over par, they were trading, let's say, at 105, 110. You know, par is 100, 1,000, as you all know. So when there's a discount, that's a tailwind. And history has shown us in recovery years, bonds tend to do well after negative years because bonds are not supposed to lose money. On the equity side, look, a lot of companies are flooded with cash. And as long as you have cash, you can pay your dividend, you can pay to do research, you can open up different plants, and you can hire more people. So the unemployment rate is very low. I believe it's about 3.7, if I have my number correct, on the last reading. So that's a very low number. So certain industries are not doing well, but that more has to do with interest rates being at a high level. Case in point, the housing market in the existing home markets, and then of course something like the auto industry, where obviously people don't necessarily want to take a financing at 7%, on a car when they may have to do it on $20,000, $25,000, $30,000 plus kind of thing. Those are the industries that are really being hit hard. But the rest of the market has done pretty well. And if we do see slowing, John, I think there is a repair to that. And I'll say this. If you're getting 5% right now to sit in cash and you don't see the velocity of money as we get closer to the summer, the Fed can fix that with a stroke of pen. They can lower rates, which would bring the money market rates down, the CD rates down, which would create that velocity of money. So the truth is, most people you're going to talk to are going to tell you they're pretty bullish on stocks in general. They might think maybe some of the S&P 500 growth stocks are a little expensive, but the earnings are there, and that's the key bottom line to anything. If the earnings are there, people will continue to buy equities.
Great. Well, Danny, you've been very helpful. We appreciate you taking time to give us an overview of both equities and bonds for this year. For everyone on the call, we'll be posting a replay on our website here in the coming days. So thanks again for joining, and we'll see everyone soon.
Thank you. Have a great day, everybody.